So to kick things off, we have our Mining Investment Leaders panel. And so I'd like to welcome up to the stage Cathy Nader, Principal Mining and Resources at Nedbank, Shaun Usmar, CEO and Director at Triple Flag Precious Metals, Julian Treger, President, CEO and Director at CoTec Holdings Corp, and Michael Wrotniak, Investment Manager at Orion Resources Partners. So let's begin by just doing some quick introductions to our panelists. So Cathy, if you want to start.
Thank you, Amy. Cathy Nader from Nedbank. We are a leading mining finance bank with an African focus. We're very fortunate in our mandate is across all commodities, and we finance from the DFS level, from project financing right through to producers across the product spectrum. We are very supportive of the energy transition, and we've got a strong focus on critical minerals. We are currently finalizing a transaction for Paladin Energy for the restart of their Langeheine uranium mine in Namibia. And we also work very closely with our energy team to provide renewable energy solutions to our mining clients.
Yeah, I'm Shaun Usmar, CEO of Triple Flag. We founded this company nearly 8 years ago with capital out of New York. We listed in Toronto and New York a few years ago. We've deployed about $2.3 billion in this space, and really through streaming and royalty financing, where low cost of capital, long time horizons, and really trying to partner with other complementary pools of capital and good miners. And that's included South Africa, where there's good ESG, good partners. We put a few years ago 145 million in with RB Plat, which has been a great partnership. And we're actually off to a site visit on Thursday on a brownfields restart in the Western Cape, which we're looking at with the IDC. So mostly operating assets, byproduct driven, a lot of it energy transition metals, but we're precious metals focused, and there's often a clear arbitrage on the cost of capital that we can offer the miners. That's our focus.
I'm Julian Treger. I have two interests in the natural resources space. One is operating mines, which we turn around, and we have stakes today in copper assets, iron ore, and also thermal coal. But my main interest these days is developing a CoTec, which hopefully will be the answer to why there isn't a sort of eBay in the mining sector. So we look for disruptive process technologies, which are super green, much lower cost. We take stakes in those technologies, and then we look for assets which the technologies can be applied to, which were previously considered not valuable, but with the technologies, they now are economically viable. And we have interest there in copper, iron ore, and rare earths. And the idea is to eventually have 7 or 8 technologies and 40 or 50 assets, particularly with an emphasis on waste recycling, because I think the whole circular economy is going to be a very interesting theme going forward.
Thanks. Good morning, everyone. Thank you for coming to watch us. My name is Michael Wrotniak. I'm an investment manager at Orion Resource Partners, based out of London. Orion is a private equity fund that is exclusive to the mining and metals sector. We focus on later stage investments, so primarily construction finance or M&A capital over producing assets. Pretty global mandate, but we're very active in Africa. We've invested across South Africa, Namibia, Western Africa, and certainly have a lot in the pipeline as well. Thank you.
All right, great. So, I thought it's always good to kind of start off these sorts of sessions looking at, the global macro environment and take a sense of what's happening there and how that's impacting the investment scene. So what is the impact of the global macro environment right now on exploration and project financing? And what do you think this means overall for the junior sector? So maybe Cathy, if you want to start us off.
Thanks, Amy. So I think, we're in a global sort of downturn and macroeconomic environment. We see a margin compression with costs going up, prices coming down. And the impact of that really depends on where the mine is in their development phase. For example, explorers, this really impacts their inputs into their DFS. So the impact is around the DFS, and our view is if you can get a DFS done in that kind of environment, it really indicates a strong, robust project, and it will attract capital. If you look at a project in the development phase, I think it really depends on where they are in their contracting cycle, what costs they've already fixed in, um, what equipment has been paid for, and the focus for financiers in this type of situation will be around potential cost overruns, as always, but there will be a much stronger focus on that. And it'll be important for financiers, the access to the equity markets for a project in the development phase, and how they're going to manage a cost overrun. Then if we look at producers in the junior sector, I think the real impact is the price impact, and that would be, where they're on the cost curve is critical, because, the cash flows are under pressure, and the focus will be around cost volatility, price volatility, off-takes, and the financing will be structured really around that. You always get outliers to, the sort of situation. For example, uranium as a commodity is very much linked to the energy transition and less to economic factors and such as industrial minerals. And that's where we really see global demand-supply shifts balancing macroeconomic environment.
Yeah, look, I think the themes are consistent in most of the jurisdictions. I think the one thing we've seen, so we've got about 235 assets now in our portfolio, of which 32 produce. And of those 32, we funded, with some very large checks on occasion, about 5 into production just pre-COVID. And it was kind of interesting because it coincided with this margin compression, inflation, which I think we're not out of yet, the supply chain issues. And I wonder with what's happening with the Red Sea now, what we'll see again with supply chain and possible inflation for the sector, just to add challenges to mine development. But I think one thing, which I'm not sure if the others have seen, but of the 5, that included a greenfields project in Mongolia. We put money in, helped these guys build the mine IPO at a time when Rio was having a tough time in Mongolia. So finding the right partner, guys with a good track record, and then standing in their corner when inevitably things are tough, I think is important. And if you find the right funding partners, I think that can make such a big difference to guys, because ideally it's a long-term capital deployment business. You need guys who aren't trying to just make a quick return, and also you look at their track record, because that's really, really important. It's who you get in bed with over the longer term, I think makes a difference. But I guess the one thing I'd say is we funded, of those 5, one was in Colombia. They did a wonderful job during COVID bringing it on. They've expanded by 30%. Mongolia did a great job. But interestingly, the 2 US projects we've got have struggled. And I wonder if part of that is actually a function of the mining sector being less relevant in jurisdictions like that, an economy in full employment. And I think in parts of Africa, you've actually seen a number of very large projects quite successfully come on. And I wonder if that's partly because of a skills thing. Capital can actually flow quite well when people find religion. But finding the right skills, I think we've got a big challenge for that, for the sector as a whole. Africa might have an opportunity, or certain parts of Africa.
Yeah, I would agree that skills and costs are big issues now. But obviously also the state of the stock market, I think, is a big theme. The capital markets, particularly the equity markets, are broken down. And for anything other than the very largest companies, there's really very little cash available. It's the result of decades of indexation and short-termism. So, I was speaking to somebody last night they've just listed Anglo Gold in New York, and it's too small to get the attention of US investors, even at that scale. So it's a real problem, how you access capital. And the other ongoing issue which makes things tricky from a macro perspective is it's very clear that whatever China has a lot of, you've got to stay away from. So, we've seen what's happened to the nickel market, the lithium market, now the electric vehicle market. It's a market full of sort of landmines you've got to really tread very, very carefully. So it's a moment of opportunity, and you see things like uranium really having shortages. But then there are other things where, if you make the wrong bet, you can really be wiped out.
And I would just add to that really quickly on the equity markets point, Julian. I mean, a big part of our business model is investing across the capital stack. So any term sheet from Orion is typically going to have a piece of senior debt, a piece of something product linked like a royalty stream, offtake, things like this, and then a bit of equity as well. And people kind of laugh and say to me, well, your job must be really easy right now because there's no equity markets. And actually it's very difficult because we've also talked about the inflationary pressures. And if you don't have, if you're building a mine, which is hard enough, I think we all know that, if you don't have that significant equity buffer, you're probably going to be in a world of hurt come year and a half down the line. So I think the this global environment is great. We're trending in the right direction, but there's certainly a lot of headwinds which are proving difficult to navigate, if you will.
So, I think there's a few key themes that we're noticing in the industry today. So, the importance of gold in kind of turbulent times, but then also the energy transition thematic, which has really kind of grown in importance in the industry overall. So, to what extent do you see these different themes impacting the flow of financing, both globally and, regionally for African projects?
So, Amy, I think the energy transition has really probably overall grown the pool of funds available into mining. Of course, you get investors that are tilting their portfolio to energy transition specifically, but investors have consciously earmarked funds for the energy transition, and often because they can get funding at favorable rates, but really to build a green portfolio going forward.
Yeah, look, we're precious focused. We're about 95% gold and silver, but we have copper and nickel in the portfolio. And I'd say more than 70% of our ounces, though, come from copper, PGM, and other mines where it's byproduct driven and somewhat symbiotic. And the challenges I think we've seen at times is just the herd tends to run all at the same time, and then that will get scared at the same time. So I remember we had an opportunity to put several $100 million into a cobalt situation. And we had guys saying, hey, what's the rate of return you want? Well, what was the cobalt price you're underwriting? Because I came out of the nickel business for the longest time with byproducts and the prospect of DRC ounces. We were $10.50, $11 an ounce long term. At the time that deal was struck, guys were underwriting $32 an ounce cobalt, which of course since has disappointed. So I think with some of the energy metals, particularly where there isn't a big terminal market, or there's a lot of volatility. It's funny how the herd runs all together and then goes away. And there's some big structural changes. Lithium, we've looked at brine, spodumene, hard rock clays. We've only ever put in one term sheet over the years in that because it's been so uncertain. So I think it's an inevitable force. I just think you have to be super careful and probably focus a lot more on where the cost curve is, to your earlier point, also the resilience and the financial leverage that the situation or that particular project is subjected to, because we're finding at the moment a lot larger opportunities coming back, but very often there's too much burden on the cash flows. Under the returns look good sometimes, but if things don't go to script, you're betting the farm, and that's a challenge.
I think for Africa, the emphasis on security of supply, the breakdown of the global supply chain, the fact that different governments and strategic alliances are much more interested in getting security of supply is a good thing. And because Africa is relatively unexplored. So I would imagine, in the same way that when we saw the war in Ukraine, we saw a lot of people pivoting to Africa to look for opportunities and seeing it as a actually paradoxically safer jurisdiction. The markets continue to evolve dynamically, but the great scramble for security of supply, I think, will be good for Africa overall.
And I would definitely agree with that, Julian. And I think one of the, in terms of financing and how this EV or energy transition has affected the flow of capital into the sector, the biggest thing has been the government involvement, I think, in locking up this, supply, specifically from the North American governments and the U.S. in particular, is really going out into Africa now and trying to, for lack of a better way of describing it, ensuring that these resources don't fall into the hands of China. But I think that the next step here in this transition is we really need to get more generalist funds, generalist capital into the mining sector, right? We still really haven't seen that. Unfortunately, mining is still a bit of a dirty word. So while the big, blue chip private equity funds, the Blackstones, Carlyles, KKRs of the world love the energy transition, and they're weighting their portfolios very heavily towards the energy transition. Unfortunately, none of that falls upstream. It's all midstream, it's all infrastructure, and I think they're missing the plot in that, well, yeah, this stuff is great, but I don't have to preach to the choir in this room, but without the minerals to flow through that infrastructure, what's the investment worth? Not very much, in my opinion.
So, I mean, how do you think you gain that generalist interest into the market?
It's a great question. I think it's certainly not going to come overnight. I think we have to continue to demonstrate that the mining industry, when done right, can be very, ESG friendly. I think it all comes down to that. It comes down to being good citizens, good operators, ensuring that, your ABC policies are up to speed, et cetera, et cetera. But I think there's been enough negative press in the mining industry, even in the last 2 months, that, one step forward, 3 steps back, it doesn't help.
Yeah, I just said, I think one of the features here, it's a bit like a unicorn hunting at the moment because the generalists are super scarce. And I think one of the things I agree with the ESG point, it is a bit area specific, like we find a lot of that conversation unfolds in Europe, parts of North America, and the United States at times. It's a bit of a bipolar conversation, and I think that's just the political backdrop, it seems. But the other one is what Julian picked up on, I think, is it's just scale and relevance. Like as a sector, a lot of this is still too small for the very large pools of capital. So I think if you find a thematic where people are excited, can you actually offer something, or could the sector find opportunities to consolidate and generate better returns and better scale and relevance to the generalists? I think we've seen some of it, but there's a long way to go.
I think we are at a really important point because there is certainly not enough money available to fund the energy transition, and I think people are starting to get worried about it. And there are some initiatives that people are talking about, particularly via the United Nations, to try and change the image of the sector and get much higher amounts of capital coming into the space. So I think that's being worked on slowly.
Does anyone in the audience have any questions before we continue on?
I'd just be interested in getting a bit of an update on how you see supply and demand across a few metals. A lot of things appear to be moving into supply surplus at the moment where we had been looking for deficits. I think copper is a prime example of that. But I'd just like to know, and then maybe uranium's the other way around, the supply tightening has come slightly ahead of people's expectations. I'd quite like to get a take on a few of these metals. You can sort of pick one or two each, but lithium's obviously been interesting because it consolidated back to a more reasonable price, and then, hey, it crashed way through that down to a really pretty low price. So, and these are pretty disruptive moves if you're trying to finance projects, as you know. And I guess I'd quite like to hear your take on a number of these metals. Copper's right up there, but nickel's another interesting one.
Philip, I continue to go back to whatever China has lots of or access to lots of, stay away from, because they can clearly utilize predatory pricing to try and stop Western responses. And unless the governments in the West provide price, caps, which could happen longer term, because that's what they're going to have to do. Those are very dangerous places to be. But copper, they don't have much of. Uranium, they don't have much of. Rare earths might be a different situation, even though they have lots. It's so strategic to the West that they will potentially provide price incentives. So you've really got to look at it commodity by commodity. But I don't know, Mike, do you?
Well, I have one commodity. I'm going to go a bit off-piste here, if you don't mind. We've just done a deal in high purity manganese, and I did a very deep dive into that market as part of our due diligence, and I think it's a fascinating market. It is one where I see, strangely, on a global level, actually very oversupplied. But if you sort of separate China and ex-China, it's really going to be a bifurcation of the market. There's no one in the West who's producing this stuff. There's one mine here in South Africa, MMC, and there's one small processing plant in Belgium called Verbrance. Other than that, there's no Western producers of this stuff. And so, well, what's going to happen? Well, if you want the IRA benefits, you're going to have to find Western sources of high purity manganese. If you want to comply with all the EU, traceability and sustainability regulations and protocols that are be putting in place, you're going to have to find this stuff in the Western world. Now, right now, the price in China is not even remotely close to incentivize any Western price or any Western project to come online. And so the way we see it, and again, it's a bit of a gamble, but the way we see it is that, that bifurcation in the next year or two is really going to kick in, and there's going to be a massive premium to Western high purity manganese as opposed to the Chinese product. So again, maybe not the most mainstream, but that was a bit different.
Yeah, and maybe just to add, so I moved to Canada in 2006 when we took over Falconbridge at Xstrata as CFO of that business, and that was the early stages of looking at nickel pig iron coming out of China. And from a Western lens, it's, well, this makes no sense. You're digging mud up in Indonesia, Philippines, and elsewhere, shipping it with water halfway around the world and making low-grade ferronickel. How does that make sense? And clearly they have. I mean, their capital cost and their ability to execute was incredible, and then how they vertically integrated these plants. But at that point, I remember thinking, but there's always going to be some degree of bifurcation on class 1 nickel with the sulfides and, with the ferronickel. But you look at what they've done in Indonesia now and the supply that's come on in such short time. I'm really concerned structurally for what that means. I know a lot of the Europeans have been saying, well, there's going to be a premium available for green nickel, and you need this for the energy transition. But I'm not convinced in the short term that you're going to see that. We've invested in some nickel opportunities in the US, and I wonder, with the world fracturing the way that it appears to be, the way you are going to see some bifurcation on national security and other grounds actually emerging, going back maybe to some of Julian's earlier points. The other ones... sorry? I think you're seeing some examples already, certainly cheap funding being made. The project in question, we've got the Department of Defense and Department of Energy funding in order to assist with that. Yeah. And I do wonder if you'll see some of the pricing being helped over time. Copper's a longer conversation. And the one I'm structurally bearish on, candidly, is palladium. I think the Southern African basket with more platinum in there is not a bad thing. I think some of the North American palladium suppliers, which are the basket's very palladium rich, I think they've got a bit of a challenge.
Could somebody comment on iron ore? And that must be an outlier in that it's about the only thing which hasn't come down.
Well, China doesn't have much iron ore, so that will keep it going. But I think. You can't assume the prices stay the way they are, but they're unlikely to collapse in the way that you've seen lithium or cobalt really, plummet.
It's interesting when you talk about what China has. For example, China has uranium, and that is an outlier. But it's quite an emotional topic, the security of energy supply. So that, completely overlays that concept of China, where you see the Western countries really wanting to ensure security of supply and not have geopolitical risk around that supply.
Hi there. Money follows money, and this sector's gone down a drain with the available capital over the last 3 years and arguably the last 15 years. What's going to turn this around, and how are we going to incentivize the generalists, which you mentioned earlier, to come in? There are some new funds beginning to evolve. I think it's fair to say that all of them require responsibility as a heart to bring money in, and therefore that ultimately could lead to confidence and trust back into the sector. But how do we incentivize new money to come into the sector and reverse the trend over the last 10 years?
Well, I think I don't know if I agree with you on that point, but from our perspective, I firmly believe if you've got a very strong management team, a good resource, you will always attract capital.
Yeah, just on the thematic, we had a few guys over at a dinner last night, and we were just saying, I think CIBC put out some research a week ago talking about specifically some of the UK and European specialist funds a decade or so ago had about 60 billion to put to work. There's like half the number of funds and a quarter of the amount of capital available from those dedicated funds currently. So you've got some specialist capital that's hung in there. The generalists remain pretty scarce. I do think, though, if you do start seeing conviction again on energy transition or thematic, there will be funds flow into that. But I think if ideally you can get some critical mass consolidation and then some actual execution by the teams in there, that's going to create some trend. Go back to the super cycle and you think about it, 2002 or so, not a lot of conviction. You think about in a fairly short period of time how much capital and share price appreciation we saw over that time, talent coming into the sector over those periods because there was good jobs, good opportunities, and just as quickly as it arrived, it seemed to turn off again. So it is a cyclical sector. It will happen again, and I think this presents a window of opportunity for those with the ore bodies, the opportunity that can marshal capital to hopefully be ahead of that cycle.
I mean, Jamie, I think to think about the stock market in the way that it was is really inappropriate. It's like done and it's broken, and unless you've got like a $10 or $20 billion market cap, it's not a place where you're ever going to get any investment. So you have to think differently. But the way in which the governments are getting involved, the IRA, even little Canada has put together a $14 billion fund for the energy transition. I mean, the UK has no money, but one day they will also have to get involved. But I think the Saudis, haven't done much yet, but they will be players. So I think the market is changing, the players are changing. It's becoming much more strategic. As I said, I think the UN is going to be pushing an agenda to try and get, BlackRock and Fidelity and others to Norgus to come back into the sector because they recognize it's necessary to cool the planet.
But on Shaun and Julian's point, do you not feel, and really, Julian, to your point, do you not feel the stock market may be broken simply because there's an anti-brown sector investment capability? And we need to effectively raise that credibility and trust within the mining sector as part of the brown sector to effectively attract capital.
Well, no, I think there is that sort of idea that we disturb the planet and are unhelpful. But I think the nature of our sector is a long-term sector. The nature of the stock market is 5 seconds or at the very longest a quarter. There's a tremendous mismatch between the time horizon of our business and the way the stock market's evolved. And then you have the idea of the large caps and the indexation. I think there are quite a lot of challenges. And the problems with the stock market aren't specific to the natural resources sector. It's quite broad. So I don't think we're being particularly targeted here.
And I must say, I think you're onto something, though, as well, where every mining executive for time has been trying to do a better job of advocating for the opportunities that this represents, because it isn't just the old images that everybody remembers of, people manually digging stuff out the ground. Like our largest investment is in Australia, $550 million we put into a copper asset that's been going for 35 years. At the time, we had a very good local Chinese partner, CMOC, and it's just been taken out now by an Australian company. But the weird thing was almost the prejudice that went with that with the sector of investors, where there's an assumption of poor ESG practices and some sort of arcane mining method. Whereas the reality is it's the first fully automated underground mine in the world. They've got decades of mine life ahead. They win ESG awards. And there's a guy with a joystick in a control room that isn't the image in the minds of people. So I think you see these studies all the time. Kids growing up thinking ketchup comes out of a bottle and don't make the connection with tomatoes. People think electricity just magically appears out of a socket, but they don't make the connection. And I know I'm speaking to people that deal with Eskom occasionally, but there's these realities of the supply chain that we've actually become blind to. So to your point, I think there are these factors which are, we need scale, we need relevance, and there will be a cyclical conviction that will return. But we also do need to do a better job of advocacy, and particularly the work that we do on the front lines with remote communities. There's so much more that the sector does than pay taxes. And it's amazing how what tends to stick in people's minds are the tailings disaster that happens in Brazil or whatever else, as opposed to all the really good work that I think, top tier mining companies do as part of the economy.
I think that's a really interesting point, actually. You sort of struck a nerve with me, thinking that, well, the only thing the generalist community and someone who's uninformed about mining will ever read about mining in the papers typically is bad. You read about tailings disasters, you read about, ABC breaches, et cetera, but what you never read about is, XYZ operation just had 5 million, LTI free shifts. That's pretty amazing as well. But unfortunately, people don't see that kind of stuff. We do, we appreciate it, but unfortunately, I don't think that's enough.
I was just going to ask, could you say a bit more about strategic government funds? I mean, it seems to me, I think it was you, Shaun, who said earlier that it's all been sort of midstream rather than upstream. Do you see, perhaps it wasn't you,
no.
But do you see government investment in strategic assets, from one country into another? Is it possible that you'll get the Canadian fund, for example, investing in an asset in Africa and actually investing upstream? Because that's sort of, it's quite political, isn't it, when a national government invests in a project in another nation, albeit a small African nation.
Yeah, so we are seeing in some of our projects, but it seems the US government with IRA has been putting some real money to work. And I think their challenge has been almost finding the right opportunities and then navigating the bureaucracy in order to effect that.
And are they doing it at a governmental level, or are they actually investing in private companies and letting shareholders make some money? Because otherwise...
No. So the ones, it's super low cost funding, effectively grants and that have been made available as part of, a broader capital formation opportunity. But I think the challenge is that money is only part of the problem. At the end of the day, if they truly want to unlock some of those critical minerals and energy transition projects on national security or energy security grounds, they also need to fix the permitting process and all the barriers that exist in order to actually get these things done, because there seems to be a lag between, I think you're seeing it with Cobre de Panama currently. There's a great mine with tons of capital that's been developed, 1.5% of global supply, 5% of that country's GDP. And DiCaprio's up there sort of, wonderful. They've been able to take a mine down. But the reality is, if you do that, you're underwriting the status quo, I believe, from a fossil fuel point of view. I don't understand the mindset. And they follow best practices, and certainly the local communities seem to, be on side. But you've got a very strong anti-brown lobby and a number of others in there. So unless they can actually fix that apparatus over and above just getting government funding, I think you're going to see these sort of dislocations continue.
I mean, obviously the Chinese have been doing this forever and continue to do it, but the US has invested via TechMet into Rainbow Rare Earths recently in South Africa. And I think that's the first of many. And the US delegations here have grown significantly in recent years. So I think they're very interested in really pursuing that strategy now.
I think in the sort of commercial bank environment, we see a lot of investment from foreign governments through ECA-backed deals where they are trying to secure supply of the product or to promote the supply chain from their country into other countries. So we do see that in the commercial bank environment.
I would just say, maybe it's a patriotic thing, but the DFC in the US, I think, is actually doing a very interesting job through their investments with TechMet, but they're also direct lending to a lot of smaller companies throughout Africa as well, it's a refreshing change. As you say, China's been doing it for years, and it's nice to see the US, I wouldn't say waking up, but starting to take this macro environment a little bit more seriously.
We've seen the DFC do an actual grant into a graphite player in Uganda, which I was a bit surprised about. It appears not to be repayable, so that's kind of interesting too.
Yeah.
So, we've already started to touch on a lot of these ESG topics, but I thought that we could dive a little bit deeper into this. Looking at potential investee companies, where do you kind of put your ESG rigor? How are you making these types of strategic decisions with the lens of ESG? You already spoke a little bit about finding the right partners and stuff, but maybe you can elaborate a bit on that.
Sure, Amy. So, I mean, obviously, we will do the normal DD, very intensive, comprehensive environmental DD with independent consultants, internal consultants. But I think what's more important, particularly for us at Nedbank, is this concept of a social license to operate. And, it's not a tangible license that you get. It really speaks to the management team's value system and how they interact with their communities, all the extra positive things that they do, which you don't hear about. And it's not just about ticking a box, they've ticked this environmental goal. It's where they do more than what is necessary to create sort of sustainable mining and really give back. And we see this as a key strategic risk mitigant. Look, for example, at Cobra Panama, where they've lost their social license to operate. So that's taking ESG to the next level, where it's implemented with sort of sincerity.
Yeah, look, I think to add to that, we're in investments in many cases. Some of these assets will continue beyond my natural life. And it's not like an equity investment on a stock exchange where you're here today and maybe tomorrow you're out of it. So you have to really take that extra time. And you also recognize the risk is management teams come and go. Maybe that philosophy changes, but that's part of it. I think the best example we can give, or I can give, would actually be Abiplat as an example in South Africa. For us, we started by surveying the opportunity set for the platinum space in South Africa from Toronto, and thought really from a social license point of view, who do we think does a really authentically good job? And it's not about reading Sustainalytics reports, because the smaller guys don't get Sustainalytics ratings. So it's actually being on the ground. It's actually looking at the quality and the culture of these management teams, looking at not just what they tell you, but doing work around that with the communities and elsewhere. So we were very happy to do that deal with them. And we'd only identified at the time, I think, 2 groups at the time in the country, which Abiplat was one.
And the other?
I don't want to share that. But the conclusion was the ultimate risk mitigant was that social license. And like our experience, even when, so we put $100,000 US a year scholarship programs in place for their local communities and their employee workforce, also to try and give back to the mining sector. When COVID hit, we put an extra couple $100,000 a year just to help their local communities have connectivity for schools. The work they do in building housing, school programs, things like that is exceptional. You don't see that when people talk about the mining sector. That's the sort of stuff that happens. And so to me, that's the sort of thing that we focus on a lot.
Maybe that's the missing link to getting more generalists involved, just kind of understanding the actual work that happens.
Yeah, it's just not as sexy as a tailings dam burst, unfortunately. And I think the other problem is I think there's a lot of cynicism amongst a lot of generalist investors on that. They do think it's greenwashing. Whereas I think if you take the time, there's a lot of really authentic, good work that is done on the front lines.
I mean, I think the whole ESG area needs to be rethought a little bit, because it was set up in the late 90s when the corporate governance movement arose, before the global concerns about global warming. And so I think there needs to be much more emphasis on scope 3 than the micro, and how you measure scope 3, which needs to be done in a uniform global fashion to be believable. So I think there needs to be a rethink now. It's 30 years, time to reimagine. And I also think with regards to recycling, there needs to be provision made for the circular economy much more than historically has been the case. So that needs to be rewarded when you're not actually mining, but you're ameliorating.
Cathy, I really liked your point around ticking the box. I thought that was quite relevant, because I think you can do all of the DD in the world, and a particular company can on paper be doing all the right things. But at the end of the day, if that management team are only doing it to tick the box, and if their principles aren't naturally aligned with what ours would be, and what I assume all of ours would be on this stage, what's the point? It's going to break down. So I think it is really all about partnering with the right teams. I think that's so paramount. I think it's an underrated portion of the due diligence that, investors do. Technical diligence is great, but, I'm a huge proponent of the fact that a good management team can build a crappy project, but, the opposite might not be the case.
How do you assess what makes a good management team?
So I think obviously it's the normal things, their track record, their credentials, their qualifications, but it's more than that. It really is about their value system and how they live and demonstrate their value system in what they're doing in their companies. Very much linked to a social license to operate. And for Nedbank, management is the first thing we look at. If you don't have a strong management team, that for us is a major risk.
Yeah, I think it's a tough gig for journalists in particular. You go sit at a mining conference and you listen to a bunch of CEOs talk about their businesses and everything's world class and it's, it all sounds the same. But I think it does come down to, this isn't the biggest sector in the world. People's reputations are built over time. It follows them. Their track record matters. I actually feel the equity capital markets don't do a great job of that, because at times you'll see if you're in the private equity space, the only currency you've got is your track record. Whereas it seems somehow there's a goldfish memory on when it comes to a team that's been able to successfully execute, and others over time who perhaps have had less. The multiples seem freakishly similar. But there's no substitute, I think, for spending time on the ground with those teams, their track records, and also teams that are not afraid to course correct. And by that I mean that it's funny how people sometimes still struggle to make tough decisions when they haven't got the right talent. And unfortunately, if you're going to succeed, you often have to do that. And some teams struggle with that.
I would just say, I think it's a difficult question to answer. I think it's very situational, right? There's so mining companies go through so many different phases, from exploration, development, construction, operations. So I think, it does come down to track record. It comes down to experience, but experience that's particularly suited to where in the life cycle a particular mining operation or project is.
Absolutely. I mean, as you go from exploration through development to production, you might need a change in management.
Different. It's such a different business model.
Yeah, just one thing maybe to add to that as well, and it's an intangible, but I think you over time you have to make your own judgments on that, is just the culture of the team and the organization. I think strategies often are fairly undifferentiated, but it's the execution and the culture that can be the X factor. And it's been, I think, a key thing for us in building our organization. I've been fortunate in a lot of the businesses we've been in to see that, but it comes down to that motivation, that drive to succeed. And you sort of know it when you see it.
Absolutely. And, when we do our due diligence, you want to get to site. You want to talk to people on the ground. You can't assess that just, on a Teams call or reading a report, or you really need to be on the ground and speaking to the people in country on the front line.
I think also just one final point on culture, and this is something that we really, discuss with our portfolio companies quite a bit, and it's the fact that bad news is okay. Right? We want honesty here. Don't sugarcoat everything. If things are going astray, well, talk to us. We're your partners. We're here to help you. Let's work through this together. But if you hide it from us, well, it's going to be too little too late. So I think, that honesty and that type of culture, I think, as you say, is quite important.
We have a question from the audience.
Julian, just to pick you up on your point on Scope 3, I was intrigued by that. I don't think anybody discounts or in any way disagrees with the fact that Scope 3 is important. We've got to reduce the carbon issues of the mining industry generally. But for this industry to get its feet on the ground, for this industry to gain its reputation, is not going to be driven by Scope 3. It's going to be driven by all the other issues of social and environmental and biodiversity. So I was intrigued that you feel as though Scope 3 is perhaps the most important element of that. I just wondered if you wanted to comment on that.
Well, because it brings together the idea that we're in a closed, system. We're all on this planet together, and the more we can give that message, I think that's a way in which the sector starts to rehabilitate its image. I think obviously local problems are problems and are best avoided, but in order to really make the world understand how important we are to the reduction of carbon emissions, I think Scope 3 is a more powerful tool.
So, we're seeing quite a few investors starting to look kind of across the EV value chain. I thought we could look a little bit into new opportunities that you're seeing arise. I think somebody started mentioning the circular economy and recycling as kind of another space that's coming in. Maybe you want to kind of talk a little bit about that.
Well, sure. I mean, everything evolves. So I think as our sector evolves and there's clear shortages of supply and demand in certain commodities, urban mining, reusing what is already in the economy is a way to bridge that gap. And I think it's also a way, Jamie, in which we can make the world understand that we can fix up the problems of the past, that the historic tailings dams can be rehabilitated, they can be shrunk, they can be beautified. So I think this is a way in which, over a period of decades, the sector can restore its reputation. So I do think the use of technology and recycling are keys to the way in which we can get higher ratings over time.
So, have a few kind of short questions that I thought we could just do some, lightning rounds. So, maybe we can look very quickly at what do you see as some of the biggest risks and then some of the biggest opportunities for the sector moving ahead?
Well, I think we've chatted a lot about this. Management for us is a big risk. But I think the biggest opportunity for commercial banks currently, they're still the cheapest form of funding for projects. They come up with a huge amount of due diligence, which creates a lot of credibility for the project. So I think any commercial bank that can start to understand the energy transition commodities, the opaqueness of the market, the processing risk, I think that's an opportunity for commercial banks.
Yeah, look, I actually feel we've got a demographic cliff with depending on the sector, but by and large, we've probably spent more time as a sector doing share buybacks over the last decade or so than necessarily building new mines. And I feel that next generation of mine builders and talent has really not had the opportunity to really get the experience that they need. And we've not as a sector done as great a job to backfill and attract that talent to the sector. So the problem is I was chatting to some guys in WA, for example, with some of the universities and mining engineers, and they go, yeah, but we've got enough mining engineers. But the problem is not today's mining engineers. It's going to be 10 years from now. And I think that's a problem. I went to Wits here. I don't know what the faculty looks like these days, but I suspect it's nowhere near the number of people as it was when I was in university. It's a problem in Australia. I think it's certainly in North America. I don't know about Camborne these days, but how we get that, because capital will find religion and come back again at some point. But the ability to fix the permitting as a risk, getting the social license, and having the talent to properly execute, I think is a significant risk. And I think the opportunity is for those guys out there who actually have the teams, who've got some track record and can marshal capital in partnerships and execute it this time before the herd is running. I think that is a significant opportunity because mines take a long time to develop. And also the other opportunity we see increasingly is, and we're visiting one on Thursday, an underappreciated opportunity is some of the brownfields. So sometimes rehabilitation is part of it, but mines sometimes were abandoned, flooded, when commodity prices were much lower and costs have gone up. But those can be very lucrative nearer term opportunities to bring on new supply. And I think there's quite a few in this country, for example.
Yeah, I mean, I go back to my original point. Choosing the wrong commodity is the greatest risk. You can have the best management team in the world, but if they're in the wrong commodity at the wrong cycle, I've seen it, they've gone bankrupt. On the other hand, I've seen idiots at the right part of the cycle make a fortune. dishonest people do incredibly well. So you have to marry the management team with the cycle. And then obviously at certain times, sovereign risk trumps everything. If you're in Panama, you could have the best management team, you choose copper, it's all great, but it's a disaster. So, as I said, there's all these problems. You have to step very gingerly through things. But I do agree with you, Shaun. The opportunity for me is, this application of these new technologies which have much lower cost, which are much more flexible, and much greener to things that were previously considered unattractive. So I keep asking people for marginal mines. I don't want profitable mines, but I want to see, can you take a marginal mine with technology and make it very profitable? And I think that's going to be a really interesting area to work on for the next decade or two.
I think actually, in my mind, one of the biggest risks, and this sort of plays off to what you guys were saying, is actually on the processing side of things, right? It's a bit of the talent crunch question is, this stuff is really hard to process, at least in terms of the EV materials, the battery metals, right? This is not a gold mine. This is, almost, chemical processes, lithium, cobalt, nickel. These are not easy things to make. And there's not the available talent that have done it before, in the Western world at least, that know how to process it. We're seeing time and time again that, the novel technologies, great, but, it hasn't been done before. It hasn't been commercialized just yet. So, in fact, I think at least specifically to the upstream portion of the energy transition, that's where I see one of the biggest risks. But again, it comes down to talent, because if there's no one in the room that can do it, well, you're kind of out of luck.
Can I jump in? I'd like to hear something about gold and silver, actually. And I think, Shaun, you might be the first person, but we've not heard about it. I mean, what is driving gold and what's driving silver? Because I think the drivers are slightly different. And is it just central banks driving gold or anything else?
No, so if you looked at the historical regression with interest rates and that, you would expect the gold price to be several $100 an ounce lower. And I think the world we're in with geopolitical instability, I remember just over a year ago, saying, "Wow, the world's a crazy place with Russia, Ukraine," and you seem to be seeing, even in this inflationary higher rate environment, gold holding up quite well as a consequence of that.
But maybe the Chinese central bank in particular.
Well, we've seen a lot of central bank buying. I think this narrative around the weaponization of the dollar and the monetary system, you're seeing the desire for China, Russia, and others to have an alternative. There's been a lot of central bank gold buying that continues. And we've seen some Chinese retail buying, I think, on the back of the fragility of what's happening in the housing sector. And that's a phenomenon that's been highlighted. But it's interesting to me that if you look at the World Gold Council report that just came out recently on Q4, year on year over the period, gold was down 10, 11% on the demand side, and you've seen some ETF outflows. And despite that, gold's hanging in there pretty well over $2,000 an ounce. Problem is, it's not being shown up in the equities. I think margin compression is a large part of that story. But in some metrics, these equities are so deeply underwater. So if they can get equity, it's super expensive.
And then silver, I mean, the drivers on silver used to be the same, but they're not anymore. I mean, silver driver is more industrial now.
It is more, but it's funny. I heard a theory which I'm not quite sure what to think of it, which is, depending who's in the White House at times, you've had these opportunities where guys that sort of poor gold component to it, people find religion and they pile off and into silver. And I think we've seen elements of that over and above the demand for solar and things of that nature. We've seen that ratio historically be at a gold-silver ratio at about 76 times. We've seen it then in the last year at about 83. I think it's not far from 90 at the moment, and it's sitting around $23 an ounce. But what we haven't seen yet, and I think there's an opportunity, depending as rates come off, we've seen silver rally well past gold and go over to 50 and thereabouts. So I think that's the X factor for silver, which we've got about 20% in our portfolio. I like having a weighting on silver for that reason.
All right, so we're just about ready to wrap it up, but I wanted to just get a quick kind of thoughts from the panelists about the coming couple of years. What are you expecting to see? Any thoughts or predict? I guess it's hard to predict, but what are you hoping for, maybe for the years ahead?
I think for us at Nedbank, we are hoping for stability in the African region. From a geopolitical perspective, there's a lot of great resources in Africa that we would love to fund and develop. And, it would be really good if, we could take out regulatory risk out of that so we could move into some areas. And, I think that's what our hope is for, is some stability to really leverage off our balance sheet and support mining on the African continent.
Yeah, look, I think at some point we'll see rates come down, which I think will be helpful. We've seen some companies that had a fair bit of leverage on their balance sheets that previously wasn't a challenge, and suddenly servicing that has become more of a challenge. But at the same time, I think this is not a bad time for those with the vision and the access and the talent to be actually trying to build a business, because I think if you can lock it up and in that sort of time frame develop a new opportunity or bring it online, I think that could actually turn out to be quite a good time cyclically.
Yeah, I think it's always darkest before dawn, but we're reaching a crisis point in terms of financing a new wave of mines, and so I think things are going to change, and they'll change for the better for our sector, for sure.
Yeah, we've talked so much about how broken the equity markets are today or this morning. I think that's really stifling the global pipeline, whereas you're not seeing earlier stage projects getting the access to capital they've had historically, and then they're not getting to a point where, someone like me can come in and help with project financing. And, lacking, barring that getting fixed, which I honestly don't think it's going to be fixed anytime soon, at least in the next couple of years, I think the obvious two pieces of capital that need to start flowing into the sector more is one, government, which we've talked about, but we haven't really talked much about this morning, the OEM involvement in the sector. And I think that's sticky capital, that's strategic capital that, is not looking for, a quick turn, as you talked about earlier, Julian. That's someone that wants to come in and partner with you for the long term. And I really do think, barring the equity markets returning, that we need these OEMs and these strategics to help push along the global pipeline. So I'm, maybe cautiously optimistic in the next couple of years that will develop further.
And we'll definitely be addressing that, looking at the OEMs and their kind of growing involvement in some of the panels tomorrow. But that actually brings us to the time for this session. So I want to thank all of our panelists and as well as the audience for all your great questions and answers. So thank you.